Yields break higher as signs of wage growth emerge and the spectre of longer lasting inflation starts to get priced in. Equities remain nervous as Q3 earnings kick off and guidance for next year may look ugly due to the global energy crunch. China high yield credit markets continue to implode as the other property developers miss payments. All this and more in this week's Macro Insight. Welcome to Macro Insight, everyone. Today is the 12th of October. Welcome to any new subscribers or free trialers. And let's take a look at these markets. So, what happened last week? Big moves really last week came from bonds. So if you look at this chart, is quite an interesting one. Let me just share this. And what it does is it basically shows you the moves across various asset classes, but in terms of adjusted for their volatility. So the number of standard deviations that an asset has moved based on its implied vol. And you can see that, US 10-year and UK 10-year did two standard deviations, which was actually more than say Bitcoin, which obviously has been all over the press because having a massive move to the upside, but relative to its vol, Bitcoin was only up, just over one standard deviation, whereas the bond markets did double that, right? So it's just, that's a good way of kind of thinking about markets. Make sure you kind of scale everything to how much it typically moves, and you get a real sense of the stress in markets and what's actually been going on. Just a interesting chart I thought worth mentioning. And if you were to look at UK 2-year yields, they went even more crazy, right? I think they were probably more like the 4 to 5 standard deviation type move, right? Because the UK obviously has kind of brought forward expectations on rate hikes, given the inflation outlook and what's been going on. And that's kind of helped sterling rally a little bit, but that was basically one of the real big movers last week was UK interest rates. Yeah. Okay. So then what else was going on? So, the move in bonds really, it happened throughout the week, but kind of then extended after the non-farms number. So despite what was looking on the surface like a relatively weak jobs number on Friday, I would say, the market reaction, moves in the bond market, et cetera, suggests that the market was more concerned about, the increase in wages through average hourly earnings and the fact that the low participation rate, low labor participation rate of around 61.6%, this may be a trigger for what we call a wage price spiral, which leads to longer lasting inflation. Okay. So it seems that people are holding out for, either higher wages or more desirable jobs. So that's preventing them from actually entering the labor force. Or you've even got people quitting jobs or going on strike or whatever, right, due to jab mandates, right? That's the next thing that's been popping up, right? You're hearing that, Southwest Airlines, for example, is causing people, pilots and stuff to basically not come in, right? And it's being blamed. 2,000 flights were cancelled over the weekend from Southwest Airlines, being blamed on bad weather, whereas none of the other airlines cancelled anything like that number of flights, right? So I'm pretty sure the weather would impact everyone. So I'm not sure they're really telling us the full story there. But basically the story under the surface is that, a lot of the pilots are basically, there's a pilots association who's like suing the airline over, imposing jab mandates and things like that. So, definitely a lot of sort of, unrest bubbling under the surface there, where people don't want to be told how to live their lives and want a bit more freedom than the government is really giving them, basically, right? So something to be aware of there, but that's kind of filtering through to the job market, which is quite interesting and is likely to probably continue in the short term. Okay. What else have we had going on? We had Goldman cut forecasts for growth. They did that a month or two ago. They've continued cutting. They cut forecasts for this year slightly, that next year quite a lot, and then they actually raised forecasts for 23 and 24. But basically, a few banks signaling now that they're getting more and more concerned, right? So probably the most vocal out of all the banks is probably Morgan Stanley, calling for a deeper correction in equities. They're calling it their mid-cycle transition. Couple of charts sort of on that note, a couple of charts that kind of show what they're saying. So you've got this one here. So that they basically look at what they call earnings revision breadth, okay? So kind of looking at earnings revisions across the various industries and what they're seeing, and they see that as a lead indicator for forward earnings. And they've seen that number roll over quite dramatically, which basically suggests to them it's like a 26-week lead indicator is what their models basically suggest, right? So they're seeing that earnings are basically going to roll over, okay, over the next sort of 3 to 6 months. So they're a little bit concerned, and they're calling for potentially up to maybe a 20% correction in markets. Yeah. Bank of America also saying that they think guidance for full year 22 could be really ugly, right, in this earnings season. So they're looking at Q3 earnings coming in relatively in line, but guidance being revised quite dramatically lower for next year. That's what it seems like. Okay, so a lot of people's forecasts were probably a little bit too high. The things that are kind of worrying people are, consumer sentiment rolling over. Durable goods spending was brought forward, so that that if you're going to move that back towards trend, you're going to see a bit of retrenchment in spending. Obviously, food and energy prices are absolutely soaring, and all this doesn't really bode well for growth and for consumer spending, right? The kind of cycle, the mid-cycle thing that they're talking about, some people have resistance to that argument because they say, how can we be mid-cycle? Surely we're more early cycle, given that the recession was only last year. And I think what we're seeing is just the cycle's been compressed, right? So with the sheer scale of fiscal stimulus and the reaction to COVID, basically, it's, you look at past cycles, right? So you've got, the 10-year cycle from the 90s recession, early 90s recession to 2001 as a 10-year cycle. You had a 20% correction in there that is called as mid-cycle slowdown or contraction. So this graph is showing you the forward 12-month P on the S&P 500, right? So moves down in that, or obviously moves down in the price of stocks, okay? You then had this slowdown sort of between around 2004. Again, that was their mid-cycle 20% correction. You had another one in 2010. But you look at the length of these cycles, and I would argue that since the COVID recession, the next cycle is going to be a hell of a lot shorter, it looks like, right? So, because they've just, the sheer fiscal stimulus boost that the market had kind of got us out of that recession so quickly that everything's kind of accelerated, basically, right? So he's calling for a 20% correction in the PE forward 12-month PE ratio, and we're maybe a third of the way through that, basically, if we look at markets now. So who knows? We'll see. He's definitely the biggest bear on the street by the looks of it. And you've got other people on the other side of the argument, like JP Morgan and even Goldman's, despite cutting growth forecasts, are saying equities, the dip in equities is for buying. But to be honest, I don't even think this guy is saying you don't buy the dip in equities. I think he's just saying that the dip in equities probably isn't done yet, basically, right? So that's something to be aware of. And that's kind of what all the big banks and the big strategists are basically saying. Yeah. What was the other reason for maybe the slightly more bullish case? I've been talking about slightly more bullish scenario as well, right? Looking at what Hedgeye and what 42 Macro have been saying. And it was basically that the market was relatively well hedged. We could see that from levels of skew and implied volatility versus where realized volatility was coming in. So that level of caution and that elevation in that implied realized spread was showing you that there were buyers of protection around. Okay, so the market was relatively well hedged. You also had, the rate of change of growth turning positive on the back of COVID cases collapsing. And we were seeing cyclical leadership coming out from the likes of financials, energy, even mid-caps were showing some signs of life. Whereas you had, the growth names like tech basically struggling on higher yields, and also some of the more defensives like healthcare and utilities, they were struggling as well. Okay, so you're starting to see signs of a mini reflation bounce over the next month or two. And I was kind of sympathetic to that view, and I kind of bought into that idea. Plus, we were seeing some technical signs that the S&P was maybe a bit overdone on the downside, and it was a buy the dip opportunity. The trouble is, now we are starting to see reflationary moves in commodities, right? But the problem with that is they're not demand-led, right? So we've got supply-led moves higher in commodities, and they're not orderly moves higher. They're like parabolic moves higher, okay? And these are leading, to higher prices that are likely going to be a drag on future growth, okay? And that means we're heading for a stagflation type environment, okay? So rather than seeing a reflationary move, we're seeing signs of more stagflationary sort of price action, okay? So that's why equities really don't seem to get going, in that it's not being demand led, it's more being supply side led, right? And supply bottlenecks and things like that. And then we're also, as mentioned before, we're entering into an earnings season where the energy crunch that we've seen across the globe will have a negative impact on the future outlook, right? And that's making a lot of investors nervous, basically. All this transitory inflation that they've been going on about for 6 months is looking less and less transitory by the month, basically, because the price rises are just getting parabolic, right? They're not showing any signs of slowing down. I mean, you look at CPI, yes, you've seen some pullbacks in things like used car prices or whatever, which were driving CPI higher in the summer. But then we know there's other factors like rent and shelter that are going to kind of take up the slack and probably support CPI and stop that from collapsing, right? But what's really the stress point and the pain point right now is the PPI and the supply side of things. And that's not showing any signs of abating right now. Yeah. So that's kind of the macro narrative and the things that really are going to matter going forward, and we need to keep a close eye on. Yeah. If we look at charts, see what the S&P has been up to. So, we'd had that, obviously, that pullback, which was looking a bit like an ABC correction that was complete. It had got into that 42.70 area and staged a nice bounce. But after that bounce, kind of ran out of steam at 44.30, and now we've managed to, head back towards 43.50. So relatively unconvincing bounce, and still staying within what is arguably a bit of a downtrend here. Haven't really broken above that. I think till we get our head back above 44.50, it's going to be hard to really call this correction over, I would say. So for now, the jury's still out on that. Despite, we do still have the momentum divergence on the S&P, so it hasn't broken down to the point we need to really be that scared or worried, but it's kind of in no man's land trying to figure out what to do. Right. If you look at the shorter term chart, you can see that despite kind of going nowhere for the best part of a week to 10 days, the swings have been pretty violent. So you've had, regular 2 to 3% swings in price, even though over the week we're kind of where we were in the mid 4300s. Right. So that is the sign. And, typically you don't really see that in S&P, right? S&P is a bit more stable usually, right? So that's showing you that the market is clearly has been caught a little bit sort of short gamma, or certainly not as long as it's used to being. So it's struggling to find equilibrium, and some of these moves, these gyrations are getting a bit more volatile because the street doesn't have a comfortable amount of gamma on the books, right? And we've obviously been talking about this since the market broke down below 44.50 over the last month. We ran away from a lot of that local gamma positioning that the street had. And the price action is kind of showing you that hasn't really been replenished yet, right? So the market is kind of waiting to be given more optionality, more local optionality, such that, the market can find a bit of stability, basically, right? And that until the market either bounces a good 100 points on the S&P, or a load of vol gets sold to the market, which may happen this week, given that we've got an expiry coming up on Friday, and systematic flows tend to be in that lead up to the expiry week. So we need to keep an eye on the VIX, because for now, the VIX is stubbornly holding above, around that 20 level. Bring up this chart on the VIX, you can see it's making higher lows, right? So it's really not managed to get back below that 18 level. And that's because we're getting quite wild intraday gyrations, right? Even though net the S&P hasn't really gone anywhere, that intraday choppiness is keeping the VIX relatively elevated, right? So if we do see a load of supply hit the street this week in terms of vol, and we see that VIX drop below 18, that probably gives some fuel to the market to pop its head back into those sort of 44 to 44.50 area, and things can normalize and things can stabilize, right? But until we see that, and if we continue to see market weakness, then the street doesn't look like it's got enough vol to really support things in any meaningful way, and you're going to continue to see very choppy price action. And in terms of the S&P and how low it could go, well, if that level at 42.70 breaks, then I think your next main area of support is coming in at around 41.50. There's a Fibonacci support in that zone. There's a 200-day moving average. That's probably a level that a lot of people are going to be waiting for. I would expect that level to probably hold at least on the first test, because there's a few people probably looking at that level as a buy the dip opportunity. But that's potentially where we're heading, basically, if we continue to get negative price action and negative news flow around the whole stagflation story. Yeah. If we look at NASDAQ, that's been obviously relatively capped as well. I mean, it had got as low as 14.4 last week. It had staged a bit of a bounce, a bit of stability, but it's still obviously not managed to get above this downward sort of sloping trend line, and it remains relatively heavy, right? So obviously higher yields don't help the tech sector, particularly the speculative side of the tech sector. But then you've also had things like Facebook coming under pressure on the whole antitrust issue thing. They had that big outage recently as well, that whistleblower story. So there's all sorts of stuff there that doesn't bode too well for some of these big techs coming under the spotlight. And, there's a lot of censorship going on right now, and it's basically making people get a bit turned off from some of these big tech giants and these platforms, taking away freedom of speech and that type of thing. Even, for example, on the crypto space, I heard yesterday, Pomp was basically shut down on YouTube, right? His channel was shut down from YouTube for just being super bullish about Bitcoin, apparently, which is a bit ridiculous, right? So if they really want to go after freedom of speech, then some of these tech platforms are going to suffer because people are going to leave, right? That's the reality. So watch that space, because that could be an interesting dynamic that evolves over the next sort of 6 months or so. Yeah. Sector breakdown. So saying, we're looking for cyclical leadership. We have been getting it. I mean, energy, financials have been outperforming, but not quite as dramatically last week. I mean, tech was up 2%. Energy and financials were also up there as the leaders. And then utilities and retail were the weakest sectors, but pretty much a mixed bag really on sector breakdown last week. Nothing too major to report. So the thing that's got the market a little bit spooked under the surface, and why the market kind of sold off late yesterday, was Evergrande is still in the spotlight, basically, right? So obviously that popped its head up a few weeks back, got the market spooked. We shrugged it off. Looked like there wasn't major contagion across global credit markets, but now the Chinese property market is really having a tough time right now. Yeah, so we got a bit of a dead cat bounce out of the Chinese equity market. If we look up the 8 shares here, we did get that on the back of Charlie Munger basically increasing his stake in Alibaba, and obviously things being pretty oversold and pretty beaten up. But then if you look at what's going on in the high yield market, it's looking pretty ugly, right? So the Chinese junk bond index is at local highs. Look here. So that's, yields are now approaching 18%, right? Not good. Evergrande has missed now its third dollar payment in the last few weeks. Other property companies such as Fantasia have defaulted on a payment. You've got Modern Land looking to restructure some debt. You've got some other, I can't remember the name, but you've got some other guys. The whole sector is under a hell of a lot of pressure. The bonds is like selling off by ridiculous numbers, like 20, 30% in a day. So that market really still very much under a lot of stress, okay? And then pressure obviously building on Beijing to step in and support the property market, like they kind of alluded to the fact that they would with some kind of easing or some kind of backstop. But so far, nothing's been done. The kind of speculation there is that their hands might be tied, right? So you obviously inflation around the world is popping up. The energy crunch is making some of these commodities go parabolic, and one in particular is coal, right? So if you look at coal prices and how much they've risen recently due to the global crunch, and you look at the correlation between coal prices and the Chinese PPI, it's extremely high, right? So the worry is for China that, and we're going to see some PPI prints, I think, later this week. But that is, in the red is the PPI for China, which is currently at 9.5, and coal prices have just ratcheted up. So, people are calling for Chinese PPI coming in at 20 to 30% maybe over, if not this month, but over coming months, which is an astronomical number, right? So once you've got that happening and you've got a property sector meltdown, I mean, China's not in a good place, right? And if China sneezes, the rest of the world tends to catch a bit of a cold, right? So I'd say if they do come in at 30%, 20, 30% CPI, arguably profit margins are going to absolutely collapse in China. A plunge in cash flows, which are already thin, that could lead to more defaults, more supply chain bottlenecks, and it will just reinforce the problems we've already got, right? As you get supply chain bottlenecks, you're going to get commodity prices go even higher, pushing PPI even higher, and it becomes a bit of a death spiral, basically, right? So at some point, I don't know what they're going to do. They're going to have to do something, or they have to try and do something, but they're kind of stuck in between a rock and a hard place right now in China, it seems. And if that does spiral out of control, I think it's going to be hard for global markets to not, feel some kind of contagion there, basically, right? At the moment, they've kind of shrugged it off as, this is China property specific, but actually this could be whole China economy-wide issues that are going to filter through. And their stagflation, clearly they're going to go into some kind of stagflation, and their stagflation then might feed through to the rest of the world, basically, right? So these are the type of concerns we need to be aware of. And things are definitely looking and feeling a lot more bearish if you're keeping an eye on China, basically. Okay, I know it all sounds a bit doom and gloom, but that's what I'm seeing, and I'm just kind of reacting to what I'm seeing, kind of changing my view accordingly. Basically, I'm probably a lot less balled up than I was. I was sympathetic to the mini reflation bounce that we might get into November, into Thanksgiving, but whether that bounce comes or not, it feels to me like the bigger move is the one we're kind of not going to really be able to escape, right? And a lot of things are showing signs of a stagflationary environment. And overall, I don't see how that's going to be great for equities, basically, right? So that's kind of how I'm starting to view this market. What else going on? So yeah, coming up this week, the main things to kind of be aware of are obviously you've got US CPI tomorrow. You've got China trade data, FOMC minutes, and you've got bank earnings kicking off this week, right? So obviously they're going to be interesting to see what's going on in the bank earnings in terms of lending growth, things like that, and what the bank's outlooks are. So JP Morgan on Wednesday, you've also got US PPI on Thursday, and then you've got Bank of America, Citi, Morgan Stanley, Wells Fargo, all those earnings on Thursday. And then on Friday, you've got Goldman's, US Goldman earnings, US retail sales, and some Michigan sentiment data out, right? So fair amount of macro and micro all mixed in, basically, right? So lots of data points to kind of keep you busy, yeah? In terms of rates and FX, if we have a look at that, what's been going on? So obviously the dollar had its little breakout last week. It's kind of back to the top of the range here at 94.5, but really hasn't done it with any great velocity, right? So you still see momentum indicators still relatively benign, suggesting that this dollar move is coming kind of close to its end, I would say. That's what it looks like to me. Euro was obviously broken down through that 116 level. here. So euro is probably looking the worst, or one of the worst out of the major pairs. Cable obviously had a strong bounce off, got a bit oversold down to 134. We had played that with subscribers to buy that 134.5 level. That worked fairly well, but that got helped by the idea that rate hike expectations were brought forward in the UK, basically, right? So now, if they do actually start hiking rates in the UK, and given what's going on in the energy crunch and the price of fuel and things like that, I'm not sure that's such a great idea, right, for the UK and what that's going to do to the UK economy. So this bounce in sterling might be short-lived if they do go and start hiking rates, so something to watch out for. But the pound has been trading a bit better on the back of the rates move. Yeah. Dollar yen has also had a very, very steep move higher here. So the yen's been particularly weak. A pair that I've been having my eye on recently is yen. Out of all of the currencies, yen's been probably one of the most weak, and then commodity currencies have been pretty strong. So I've been keeping an eye on this CAD yen. So CAD's pretty linked to the oil price. Obviously, oil's been flying, right? So CAD yen is at a very, very elevated level, right? Levels not seen since June. Looks very, very overbought on the momentum indicator. For me, that's not a bad place to have a stab at a short side of that. I mean, obviously, if oil rips to like 85 in the next week, you're not going to make any money on that trade, right? But I would just say, looking at all the FX pairs out there to see what looks the most stretched, arguably this is one of the most stretched right now in terms of so to play a bit of mean reversion on this, if you're that way inclined in FX, because FX pairs do often sort of mean revert, then I think this one's offering a fairly decent entry point here. Yeah. Okay. So that's what I think on FX. In terms of rates, what's going on in rates? You've got 10-year and 30-year Treasury auctions this week. The argument was that kind of earlier in the year, when yields were gapping up to 175 on the 10-year, it was because Japanese buyers were absent, basically, right? So that was one of the kind of arguments. So, let's see what happens in terms of foreign buyers of the Treasury auctions this week. But you've had 10-year obviously pop to 160. 175 was that level that we got to in March. And then on the right-hand side here, you've got basically what the Japanese guys are doing, right, in terms of what they're doing in bonds. And so they have been buying lately. Those numbers have been fluctuating, but the idea being that with yields up here at 160 relative to their domestic yields, even if you FX hedge it, those yields are looking fairly attractive for those foreign buyers, basically, right? So if those auctions come in relatively well subscribed, then that's going to provide a bit of support to the Treasury market. That's the idea. Yeah. If that happens, then we may get a bit of a bounce out of TLT, right? TLT has been under a bit of pressure. Obviously, the whole yield curve has. I dip my toes into TLT. I would probably look to add if I get price action that kind of confirms that we're getting to a bit of an intermediate support level. So here, I had a couple of levels here. I dipped my toes in around that first one. I kind of sat on my hands on the second one, and now we're approaching this upward sloping trend line in TLTs. I don't think given the headwinds for growth that I mentioned and the kind of stagflationary dynamic that I think we're going to potentially enter into, I think this might not be a bad entry point for that long bond, basically, right? I wouldn't necessarily pile into, the short end of the dollar curve because, the Fed are tapering and it looks like they're pretty much going to taper whatever comes. But I think that long bond could start to find some support pretty soon. Yeah, that's my thoughts on that, basically. Yeah. So I may be adding to some of my longs on TLT fairly soon if I get that positive price action. Okay, so that's my thoughts on FX and bonds. If we go to commods, obviously nat gas has been driving a lot of the craziness. Thankfully, finally Putin stepped in and basically made some comments on being able to supply and kind of put an end to some of this crisis that's going on in Europe. And that obviously took it down pretty dramatically. It's back to its first retracement area around 5.15. It's got another one down at 475. I haven't really been playing this, but I'm keeping an eye on it to see where the levels are, just to have some guidance. I think this market is going to drag a lot of other commodity markets and has been dragging them higher or lower, to that matter. So definitely something you need to keep an eye on. I think natural gas. In terms of what it's done to other markets, I mean, some of the oil move, oil's going a bit parabolic. It's been helped by some of the fuel substitution that's been going on. But even oil, right, if you look at that channel, it's a pretty steep upward sloping channel. We're at the top of it. I do think oil's a bit overbought right here. Obviously, I've been long it. I like the long. I've trimmed it down again a little bit at this latest level. Still a little bit long. Trailed my stops on my balance in case something crazy happens and it corrects. But you know, if it consolidates a bit and gives me an opportunity to rebuy, then I'll take it, because I think longer term this could go a lot higher. A lot of guys in the oil market are now seriously thinking we head toward 100 on WTI over maybe a 6 month to 1 year time horizon. Fundamental backdrop looks very strong in that market. All the energy markets look very, very tight. So yeah, that story is kind of intact there, basically, right? So definitely still like oil. Copper's been a pretty interesting commodity recently, just because, you know, it's been consolidating, and despite what's going on in the China property market and the Chinese economy in general, I would say copper's trading really well. You know, Goldman's put out a note. They've been bullish copper for a while. Obviously, pretty sure they're talking their own book, as they often do. But if I show you this chart, so you've got copper here, right? It's been consolidating in this kind of triangle pattern, kind of threatened to break the upside of that triangle yesterday. I think it's failed on that today, but trading relatively strong compared to what's going on in China. And if you look at the pink line, that's the speculative positioning. So whilst we've been in that consolidation phase, spec positioning is just getting taken out of the market, basically, right? So that's a healthy backdrop for if we do get an upside break, there's a ton more speculators that can rush into the market and chase the move, right? So that's quite positive. And then if you look at what Goldman said in their latest bullish comments, they're saying, you know, the market is overlooking the key upside catalyst. This mispricing is centered around rapidly tightening inventories, now drawing at the fastest rate on record and down nearly 40% over the past 4 months. With a significant metal deficit projected for Q4, global visible copper stocks could reach all-time lows by year end, and absent market adjustments driven by higher prices deplete entirely by Q2 22, right? So they see the copper market as tight as it has ever been, basically, and that's why they are uber bullish on copper right now. And, you know, looking at the price action, you know, maybe you can sympathize that they know what's going on, right? Despite the fact that you're going to get less demand out of China, most likely, from what's going on in their property market, there seems to be something taking up the slack there, basically, right? So on a global level, the whole decarbonization story, the demand for copper that's growing all over the place, that seems to be taking up the slack, and the price action so far relatively robust in the face of what we've seen. Yeah, so watch out for that. My positioning in copper is fairly light. I've got my long-term structural position that's going nowhere. I don't have anything on tactically. If we did break that triangle, maybe I would have a stab at playing a bit of a move to the upside back towards $5. But right here, right now, I haven't played it, basically, right? So kind of watch this space. I'll keep you informed on that front. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.